business planning module that we're doing is a culmination module, meaning it takes all of the stuff that we've talked about in the first 4 units, looking at finance, looking at marketing, looking at human resources, and looking at operations, and we're combining it all together into a business plan. The purpose of a plan is twofold. First of all, it's to help you figure out what you're going to do with your business long before your business starts. The second part of the business plan is for selling. You got to sell the idea to potential investors. And when we look at the actual components of a business plan has 5 subplans in it. So you got your introduction first, and then you got these 5 section headings. Now, it doesn't matter which order they go in, doesn't matter at all what we got in terms of how it's really ordered. But the fact is, it's normally ordered from the most important one being first, which is human resources, because really a business is an organization of people. So when you look at human resources, what we're really looking at there is trying to get a handle on who is it that's going to be working in this business, what skills do they bring, and do those skills complement the business idea? So the human resource plan, very succinctly, is going to say, here's who we got working, here's what they bring to this, and they add value to the company because they bring something that's of value. Okay, that's the human resource plan. The next major thing that we need to put in there in terms of a sub-plan is the sales marketing plan. Sometimes it's just called a marketing plan. But effectively, what the marketing plan does is it says, okay, we're going to talk about the 4 Ps that we talked about in the previous unit: the price, the product, the place, and the promotion. What is it we're selling? The product. Where are we selling it to? The place. How are we communicating it? Which is really the promotion aspect of it. And the price. Where are we dealing with pricing? That is really like, if we were to consider it like driving a car, that's the steering wheel and the gas pedal of a car. Those 4 things are the components that you as a business owner or business manager will manipulate in order to be able to make your business do what it's supposed to do, which is make a profit. In the marketing plan, we're also looking at selling. What are we going to do to sell it? What, the detail of how we're going to do those 4 Ps, very much part of that. The third component, the third sub-plan, is called the operations plan. The operations plan, as I said last week, is a very important part, because what it is a nuts and bolts of how you're going to run this business, how you're going to operate it. So we're looking at first, like, where is the business physically located? What does the building that it's in look like? What does the storefront look like? What are the stuff that's inside the store? Paint a picture of the actual business for me. Now, if your business is virtual, meaning it's an online business, you still have to paint a picture. What is it you're selling? Where are you selling it? What is the website going to look like? These sorts of things, okay? So no matter if it's a real bricks and mortar type business or a virtual business, that operation is going to clearly outline, whoever's reading it, how this business does what it does, hours of operation, these sorts of things. The financial part of the plan is really something that you want to work with an accountant on. If there's one part of the plan that people need to get assistance on, this is probably the part. If we look at the financial part of the plan, it's really describing your business and its activities in dollars and units. What is the volume of sales, for example, in terms of dollars? What is the volume of sales in terms of units, if we're selling units? What is the volume of our expenses? What kind of expenses? Startup expenses, operational expenses, capital expenditures, capital referring to stuff that is long last. Like if we buy a piece of equipment that's going to last 5 or 6 years, that's what's called a capital expenditure. And it's something that we pay off over time normally. Whereas just standard expenses could be something that you're going to buy and consume in this year. The financial section of the business plan must demonstrate clearly that the business is viable. Okay, this is really the scratch test on a business. You need to be able to do a financial plan, and that financial plan has to demonstrate that the business can make money. If you cannot get positive numbers out of your financial plan, then it's best that your plan stop there. Okay, so you gotta demonstrate viability. So what we're talking about is we're looking at primarily a monthly sales for a business that you project. So how much do you plan to sell in a given month for the first, let's just pick a year of operations. So if we're going to be starting next month, you're going to say, well, July, I expect sales of X. August, sales of Y, and so on. So you're going to come up with financial projections. Now, how are you going to come up with those numbers? Do you pull them out of the air? No. As I say, your financial data is really predicated on your marketing data. So you're going to say, well, you think you're going to capture 10% of the market, and that constitutes 100 people. And you estimate that 100 people are going to buy from you, and they're going to spend $100 each. 100 times 100 is 10,000. So this is where you can come up with numbers for revenue. And if you're selling $10,000 worth of product, and you mark it up by 50%, that means you can kind of estimate that your costs of raw materials are going to be 50% of $10,000 or $5,000. So these financial projections are useful, and what you're going to do is do them for the first 12 months of operation. And then for the 3 years of operation, really you should go out 3 years in terms of projections, you'll do year 2 and 3 on a yearly basis, not necessarily a monthly basis, okay? So the first year you do it on a monthly basis, the second and third year you do it on a yearly basis. And all we're trying to do there is get a handle on what do we anticipate our revenues are going to be, what do we anticipate our expenses are going to be. You should have positive numbers at the end of 3 years. Is in order to get a better handle or to present a more fair estimation of your projections, what a lot of sheets will do, these income statements or pro forma income statements or pro forma balance sheets or pro forma cash flows, what they'll do is actually create 3 sets of these. The 3 sets will be, set number 1 is an optimistic case. So if you feel that your sales you're going to capture, say, 20% of the market, you're going to create the various statements based on capturing 20% of the market. Then you're going to say, okay, what's the worst case scenario? Let's assume that the worst case scenario is 5% of the market. Then you're going to do a projections for 5% of the market. You capture 5% of the market. What are your sales? What are your expenses based on that? So that's an optimistic one, a pessimistic one, and then probably a realistic one, which is somewhere in the middle. So essentially what I'm saying is you're going to create these various pro forma statements in 3 forms: an optimistic form, pessimistic form, and a realistic form. So things to consider in order to do this financial forecast, be it one of the 3 levels, is how much money do you need if you're seeking external funding? So you're going to have to get out of this, how much money you're going to have to borrow. You're going to consider what's security that you can offer up to your lenders. If you're going to need that money, what can you put up? Your house, something you own, stocks, bonds, whatever. How do you plan to repay the borrowings? You have to generate enough money in your projections to be able to pay off the loan. Okay. Again, these are projections. They're best educated guesses based on your analysis. So let's look at some of the financial statements that you would produce in order to be able to determine whether your business is going to be profitable or not. We're going to look at the cash flow, the profit and loss, the sales forecast, and the startup cost statement. A cash flow statement really is the cash balance and the monthly cash flows for the first 12, sometimes you can have 18 months. This includes what's called working capital, which is the amount of money you got to play with, salaries, sales, all those things you're going to have to consider. And that's going to create something called a cash flow statement, which is really showing, you could imagine the cash flow statement as being like a bathtub. You got water going into the bathtub and the drain is letting water out of the bathtub. And what you're trying to do in terms of cash flow statements is figure out how much is coming in, how much is going out, and to get a sense for what the level of the tub is, what the level of the water is in the tub based on that in and outflows. And what we're looking at is on the left-hand side, down along the side, we have cash in and cash out. So you'll see cash on hand is the start, which is how much money you have in the bank at the very start. So you'll see at startup, you have $1,000 in the bank. I'll just lead you through with the numbers here. So just moving down from that, then the total cash available is at that point $1,000, meaning there was no cash receipts in the business for that very first startup, No indication of any money coming in other than that. So you had $1,000 in the bank. That's your bank balance. You look at for the startup, and there's no expenses coming out and no cash paid out, which is real honest goodness dollars being paid out. So, at the end of the day, you still have 1,000 left. Now let's go to January 01 and look at that. The cash on hand is 1,000, which makes sense. Seeing you didn't spend any cash, you didn't make any more than cash. The bank balance was 1,000. It stayed at 1,000. There it is on January 1st. During January, you had cash sales of 50, and you had loans and other cash in of $25 or $2,500 or whatever it is. We don't know if this is thousands of dollars, ones of dollars, tens of dollars. Doesn't really matter. So what we've got is 50 and 25 coming in for a total of 75. So that means you started off with 1,000 in the bank. You added 75 to it. You can see there's 1,075 there now. Okay. Now, correspondingly, there are expenses coming out of that, or costs, money flowing out of the business. This is the drain of the bathtub. So you made some purchases for 100. Now you notice there are no other flows out. So really that 1075 is what you had in the bank. You took 100 out of that. You got 975 left. And you can see in February, the beginning of February, you have 975. Excuse me. So then we go through February. We had cash sales of 70, collections, no collections, other loan money coming in. So you had a total of 95. So you had 975 plus the 95 is 1070. So you're back to 1070 in the bank account. You look down through February. Did you have any cash out in February? No, nothing. So 1070 is the beginning for March. In March, you had cash sales of 80. You had a loan coming in at 25. So 1070 plus 80 plus 25 is 1175. So you got that there. And then you made some purchases of 800. So 1175 minus the 800 means you got 375 left. There's no other expenses or no other cash out in March. So you'll see in 1st of April, you have $375 in the bank. Now, this cash flow, this is the pattern that flows right through the months. And what I want to get you to look at now is how much money do they have in their bank account? They have cash on hand at the beginning of each month. Now, you'll notice that it was 1,000, 975, 1075, 1070, 375, 505, and so on, right across. So every single month, they had positive money in the bank, which is good, because that means they got money to work with. So from this cash flows point of view, there's no need to borrow money or no need for anything, any money, any other money coming in. The bathtub is actually filling up faster than it's draining. The idea behind the cash flow statement is really to estimate when you're going to have to borrow funds, because most businesses will have times when they have less money coming in a month than they have going out. Your slow month, for example. So you need to use this cash flow statement really to get a handle on, or to project when you're going to need money, when you're going to have surplus money. So the cash flow statement is an important thing. And as I say, in a business plan, what you need is for the first year of your business, from the start date through to 1 year past, you need to do a cash flow statement for every single month, just like this. For years 2 and 3, you can do this per year. You can do it on a yearly basis as opposed to a monthly basis. So here's all the cash coming in the next year. Here's all the cash going out. At the end of the year, we have this much cash. So effectively, that's what you're saying. We're also going to be calculating what's called a profit and loss forecast, which is really doing here's all my revenues, here's all my expenses. What's the difference? If the difference is positive, meaning that you have more revenue than expenses, that's profit. If it's the other way around, that's loss. And what you're doing is you're projecting out in this. So you're picking a period of time. So they picked 5 months on this particular example. And over that period of 5 months, you're looking at the revenues that come into the business, or gain. So, there was 100,000 in sales revenue. There was 5,000 in interest revenue. There was a gain on the sale of assets. They sold something for more than they paid for it. So the total revenue coming into the business was $108,000. And then for that same 5-month period, they're measuring what are expenses or losses. So cost of goods sold, which is the raw materials they bought, commissions, office supplies, office equipment, advertising, interests, loss from lawsuit. And you can see you can get a total expenses here. So if we look at our total projected revenue and our total projected expenses, subtract one from the other, it'll give you an idea of what your net income is. So all this profit and loss forecast is supposed to do is to clearly show that the business will make some money. The sales forecast is what we're doing is projecting our sales. So we're just worried about a revenue side there, or we're just worried about the side that deals with the actual flow of products out the door because you're selling stuff. And a sales forecast is projecting how many things you're going to sell. Now, this example I got here, you're selling desktops, laptops, and computerized computer stuff. So we're looking at, in terms of unit sales, how many desktop computers do you sell, how many laptop computers do you sell, and so on. And so that's unit sales, and you get an idea how much each one sells for, the sales price, and that will give you an idea of your total sales. So if you're selling 950 at $900 each, you expect the total sales to be $855,000. Various products. Now, what if you got thousands of products in your store? I don't imagine doing one of these sales forecasts for every single product, but categories of products you could probably use. Let's say you're building homes, how many homes you're building, and what the average selling price is of a home. And so if you're selling 100 homes at $100,000 each, you can imagine that's $10 million in sales. Another interesting one that you really need to consider too is something called startup costs. How much is it going to cost to get this business up and running? Because before you make a cent, before a cent of revenue comes in, you got to consider how much money do you need in order to get the doors open to this business. Another one that we'd often want to see in a business plan is something called a pro forma income statement. And this is a projected income statement. Normally they're set up like this. So you have revenue and your expenses. You can see it down the side there, a typical income statement. But what you have is a year on year on year and year. So 2006, 7, 8, 9 are represented here. Look at our sales. Now, what we're trying to do there is to demonstrate what we expect our sales to be in coming years, okay? And we want to demonstrate that our business is growing. Okay, so in this particular business, for example, started off at 500 in 2006, and you'll see every other year after it increased. In fact, in 2009, it was 850, which is quite a bit more than what it was when it started. So you want to project your income statement to demonstrate that your sales are increasing as time goes by. And then we got the pro forma balance sheet, which is the same sort of thing. You take your assets, liabilities, and owner's equity, and you say, okay, what do I expect the balances in those accounts? Because a balance sheet is a snapshot. So you're going to take a point in time at the end of 2010, 2011, 2012, 2013. And what we're doing there is gathering up how much do we anticipate having in terms of cash, accounts receivable, inventory, and so on, our assets, how much we're going to have in terms of investments, land, buildings, in terms of fixed assets or long-term assets, how much we expect to have in terms of liabilities, in terms of accounts payable, and so on as we move through the year. So all we're trying to demonstrate here is that, again, our business is growing. If you look at the balance sheets of this particular company, you will notice, or you should notice, that as the business moves along, it grows. We've looked at some of the mechanics of this in the various components. You should have a fair understanding of how these things are arranged now. In terms of the actual numbers that you put in here, that's where your accountant comes in, because really these are templates as opposed to this is where exactly the numbers come from. You got to use the data you've collected up in your market research and in the other aspects of your business plan in order to be able to project and put numbers in here that have some validity to them. Where do you get that number to? Well, this is how I figured it out. That's what you need to be able to say to someone when they look at this statement. You need to be able to back up where those numbers are coming from.